Everyone, thank you so much for joining. Welcome to our webinar. Today, we're talking about food and beverage enterprise risk management, not transactional insurance. I'm super excited about this conversation. We really listen to what our teams and what our clients are looking for from an educational perspective, and that is why we're here today. So at the end of this conversation, I want everyone to walk away with the understanding that risk in food and beverage is a living, breathing thing. It changes every single day, and the risks that matter most in this industry aren't isolated, they compound. So think of what's going on in the news. We've seen the 2026 Super El Nino that everyone was watching very closely. We have MAHA, synthetic dye phase outs, reformulation requirements, AI-enabled plants, the Fairlife Coca-Cola cyber shutdown last week, cyclospora outbreaks, contaminations continue to rise. And so when I think about our industry itself, we're facing a number of headwinds. We're seeing acquisitions, new SKUs, and expanded supplier networks. And with that come a number of geopolitical concerns. And really, if you think about it, a single decision opens up a property gap and a casualty gap at the same time, which is why we can't look at coverage on a line-by-line basis. We're talking today a little bit about the food and beverage class action lawsuits that continue to rise rapidly. We've seen between 200 and 300 filings plus a year since 2020, and plaintiffs' firms are increasingly treating labeling and marketing claims as scalable, repeatable categories, not one-off suits. And you've seen a number of content from me around GLP-1 medications, how they're changing the way people think and eat. And that's really bringing a whole new level of regulatory attention. So our clients are just trying to grow through all of these headwinds. And that's really why we're here today, is to talk through some of these headwinds and some of our best-in-class solutions around emerging risks. So I can't underestimate or overstate the importance of linking risk management to operational and strategic success. We at Hub look at risk from the various levels, from both the operational to the C-suite level, financial, and we bring those all together to have a holistic approach through enterprise risk management. So with that, my name is Mary Kizer. I lead the food and beverage practice for Hub. I have been in the insurance industry for over 18 years with a deep focus in food and beverage manufacturing, distribution, warehousing, and retail. And I am very proud of our food and beverage practice here. We place over $2.1 billion annually in the market. And with that, that means that we can see a lot of trends that our clients are facing well before they face them. And really, that is what we're going to talk about here today. So now I'm going to introduce our panel of experts. I'll let them introduce themselves, but Mike McBride leads our property risk control here at Hub, and Christine Kruger is a senior counsel at Ashurst Perkins Coie and works in food and beverage litigation daily. So why don't we just talk quickly about housekeeping items also. We will be taking questions at the end of this conversation. We've reserved about 10 to 12 minutes at the end, but feel free to pepper in your questions in the chat, and we will address those as we get to the end of this conversation. So why don't we start with you, Mike? Would you mind just quickly introducing yourself?
Sure. Thanks, Mary. Really looking forward to this conversation with you and Christine. Great expertise here at the panel. Mike McBride. I'm the property risk control practice leader for Hub. I've been here about 5 years. I have 40 years experience from the insurance carrier side, and most recently, before coming to Hub, leading a team of 150 risk consultants globally. Great to be here today, Mary.
Thanks, Mike. And Christine?
Yeah, hi everyone. I'm Christine Kruger, Senior Counsel at Ashurst Perkins Coie, and I'm a litigator specializing in the CPG industry, where I partner with food, beverage, and cosmetic brands to navigate complex legal challenges. So on a daily basis, my practice centers on regulatory compliance counseling, really helping companies stay ahead of the evolving advertising and labeling standards, as well as emerging frameworks like extended producer responsibility regulations. And of course, when challenges do arise, my focus shifts to strategic litigation defense. My goal is always twofold: to protect brands in high-stake disputes, and to also build the practical compliance strategies that are needed to minimize risk and avoid the courtroom in the first place. So I'm looking forward to connecting with you all today. Thank you.
Thank you so much, both of you, for joining. So let's start where a lot of risk conversations start in the food and beverage space, and that is property. We've seen the market shift in 2020, beginning in 2020, it became a hard market. The market continues to evolve, and we continue to see changes with respect to what the carriers are requiring of our food and beverage clients. But I want to push past the standard cat exposure conversation, because I think what Mike is seeing on the ground with food and beverage clients is where it gets really interesting. So to start us off, Mike, when you're looking at a property schedule that's out of step with the facility it's covering, what does that usually look like? And do you have a client example that would illustrate that?
Yeah, absolutely, Mary. This is really a fundamental piece to the underwriting process, and there's no industry that has a more sensitive response to it than the food and beverage industry. A challenging industry in the insurance market. And I can think of one client that had a combination of what I would call stale values. In other words, there had been no point over the past number of years in which there was kind of a benchmark at which the building values were held to. And combined with that, there was inconsistent construction data. So, for example, what I mean by that is the area of the facilities was incorrect. We had a schedule of values, it had the values in place, and it had some what we would call COPE information: construction, occupancy, protection, exposure information, basic information, including the area of the facilities. But that area was inconsistent. And it's a very quick check for insurance carriers just to kind of divide the values, the property values, by the square footage, the other way around. And then you find that that quick check shows an inconsistency in values. It's really important to get benchmarks in place where the values are updated using external reference points, and also that the data in this statement of values is correct. We were able to work closely with this client and really come out with a better outcome in the end, but it really did highlight how important it is to have that kind of consistent approach within the valuation or the statement of values.
So when you are saying consistent approach with the valuations, are you, and you mentioned an outside, are you talking about appraisals needing to be done?
Well, appraisals are certainly the spot that most carriers would look at, and really the best place to start in terms of getting accurate building or I would say asset valuation. That's only half the equation, obviously. Business interruption would be the other part as well. So no, there's a couple different choices that you can look at. On the building side, there's tools like Marshall and Swift. There's third-party resources in which you can do valuation assessments on the desktop. But certainly appraisals are advised for key locations on a periodic basis because it's really boots on the ground that will give you not just the building values, but the equipment values. And in the food and beverage space, it's really the equipment values that drive the process more than the building.
And why are you seeing that equipment itself is really driving valuation in food and beverage specifically?
Well, when you look at the ratio of values, the machinery and equipment take up a much bigger portion of the process than the building does. And in addition to that, a lot of facilities are using older equipment, could be decades old, and the new equipment that's being installed is not necessarily going to be on a par with the valuation that was expected from the historical values of that equipment. The updates to the equipment, the digitization, there's more safety controls in it, they're more efficient. Lead times are much longer as well. And so all of those elements need to be brought into consideration, especially in the food and beverage, when a lot of the equipment is like specific to the product being manufactured.
Right. So when you see leadership at our food and beverage clients approving a big capital investment, thinking
Mhm.
like automation, a new line, or a modernization of some kind, what is the best practice from a risk perspective, um, within the renewal cycle and then outside of the renewal cycle that you see?
Mhm. Well, I think the best way to answer that, Mary, is a case study with one of our own food and beverage clients. When our client was initiating a greenfield construction project to build a brand new facility, they leveraged the construction project not only obviously for the purpose built, but also as a real-time property valuation and equipment lead time study that they could integrate into their valuation process. Every quote, every change order, every delivery delay for major equipment, particularly long lead times like industrial spray dryers, this all becomes part of the feedback loop for their entire company. It wasn't just filed away as a project specific to this one location, they integrated it. Several of their older facilities run similar spray drying and processing lines, and many of them were installed decades ago. So this gave them real-time information on what it would take to the cost of the capital expense, the lead time for the capital expense, and in some cases 12 to 18-month lead times. So what they did is they started to apply this to their equipment midterm, right? So it's really a feedback loop for them that brings benefit into their insurance program, but it's really for the company as well. So it's as you said at the beginning of this, like a living, breathing process. It's not something that we pull together very quickly just when it's renewal time.
Well, and I love that too from a business continuity planning, right? Like if you already have this data point of how long it's going to take to replace a specific type of machinery, how do we build that into your business continuity planning for the other facilities in your portfolio? It's actually a great data point and scalable, which is great. So Mike, that automation point that you brought up, I want to bring Christine in on because I think as the production lines become more automated, it's not just a property story, it's also a liability story. So Christine, what are you seeing when a machine error causes an adulteration or mislabeling issue? And tell us a little bit about how your legal teams or the legal teams that you advise respond to that and what that might mean from catching them off guard.
Yeah, no, you're spot on, Mary. When a line becomes automated or a facility modernizes, executive teams are naturally focused on the efficiency gains or the property schedule. But from a liability standpoint, automation does create risk. And if a mechanical calibration goes off by a millimeter or there's a software glitch that occurs, it doesn't typically just impact a single batch. It can systemically mislabel, alter, or underfill thousands of units before it's caught. And so suddenly the legal team isn't dealing with a simple one-off quality issue. They're looking at potential class action exposure for misbranding or a multi-distributor recall. And so the risk didn't disappear. It just shifted from, a simple error to more of a systemic operational risk.
And so when you think about like this is something that I hear about a lot, seeing the national scope of the food and beverage practice here at Hub. We are seeing a number of packaging and labeling litigations coming across our desk. What are the plaintiff strategies doing that are changing and evolving, and what is driving the current volume of these cases in your opinion?
Yeah, no, while food and beverage class action filings are continuing to rise rapidly over year, and it's important to note that public court dockets only show a fraction of the actual exposure for every single class action lawsuit that is filed in court. We typically expect there's at least, 10 pre-litigation demand letters that are served on manufacturers. And so what's driving this volume is more of an operational shift in the plaintiff's bar and how they're working. So they've turned CPG labeling claims into a highly automated business model. And these aren't, filing one-off lawsuits or sending isolated demands. They're really deploying scraping software and executing targeted retail sweeps to hit dozens of brands simultaneously with identical claims.
So do you see that our food and beverage companies should be watching certain types of litigation trends more closely? I mean, we've seen all natural and preservative-free claims come across our desk. Is that something that is becoming more frequent in your opinion? And where should our clients be focusing their efforts right now?
Yeah, no, there's several litigation trends that I can speak to that we're seeing right now. And of course, claims like all natural or preservative-free are frequently challenged. We see those all the time. So, one of the trends is that sort of all natural or clean label trap. We're seeing that absolute marketing terms like all natural clean or preservative free really remain primary relentless targets for the plaintiff's bar. And the vulnerability here stems from a regulatory vacuum. It's because the concept of what makes a product quote unquote natural lacks a bright line federal regulatory definition. And so the door is really left open for aggressive litigation there. And plaintiffs' attorneys are really capitalizing on this gray area to argue that a reasonable consumer was misled, building entire class actions around, the presence of synthetic trace ingredients. And so that's one major litigation trend that we've been seeing over a decade that continues to this day. And then we also see a lot of allergen mislabeling and wrongful ingredient allegations. And so, undeclared allergens really remain the number one driver of FDA Class 1 food recalls, and the litigation landscape following these incidents can be incredibly punitive. And so, the moment a labeling oversight occurs and an unlisted allergen makes it into retail, the case instantly pivots from out of standard consumer deception arguments and straight into strict product liability, personal injury, and negligence defense. And so for a consumer with allergies, a wrongful ingredient can become a true medical emergency.
Right. And it feels like too, there's more and more, we do see a lot of undeclared allergen product recalls, but it does also feel like there's more allergens added to the list, and more maybe even coming from my reading on this topic. I don't know if you have any opinion on that, but there does seem to be an increase of people who are allergic to more things in today.
Yeah, no, there's certainly that perception, and we are seeing an increase in claims surrounding these types of cases. And there's also, of course, the environmental and EPR sourcing claims, where the litigation front has really expanded from past what's inside the product to also the sustainability of the physical container itself. And, with the rapid rise of state level EPR laws or extended producer responsibility laws, claims like recyclable, eco-friendly, biodegradable are also facing intense scrutiny among the plaintiffs' bar. And there's a challenge for risk management here, is that we're operating in a really shifting landscape that is a state by state statutory packaging definitions to look out for. And so attempting to maintain that uniform national packaging design in this environment also creates some downstream vulnerabilities for any growing brand. So there are quite a few litigation trends that we could talk about all day long.
How is ultra processed food litigation fit into the broader packaging and labeling litigation landscape?
Yeah, so the litigation landscape around UPFs sort of marks a shift in consumer law, moving beyond the more narrow ingredient disputes into broad challenges to entire product categories. And so plaintiffs' firms and public interest groups as well are advancing really two primary theories against food and beverage manufacturers. First, we're seeing some municipal and government entities that are adopting a sort of a big tobacco approach through public nuisance and deceptive trade practices claims. And they allege that manufacturers are deliberately engineering hyper-palatable addictive products and marketing these products heavily to children, and that has contributed to a public health care cost associated with chronic metabolic conditions. And then secondly, we're seeing individual personal injury claims that are emerging on behalf of consumers diagnosed during youth with conditions such as type 2 diabetes and non-alcoholic fatty liver disease. So these claims are more of a strict product liability, failure to warn, and negligence, alleging that manufacturers concealed the metabolic risks of long-term consumption of these products. And, despite the vulnerability of these cases, plaintiffs have encountered obstacles and the courts have largely resisted these theories. Defense counsel have secured some early dismissals of broad mass tort claims by challenging the plaintiff's ability to establish direct causation. And courts have concluded that these generalized allegations about food processing do not suffice without specific evidence of product exposure and a definitive medical link between a particular product and the alleged injury. So judges are also skeptical. They view skeptically efforts to impose liability on manufacturers for selling standard consumer products that comply with established federal food safety and labeling requirements. So that's an area that we're watching closely.
Do you think that Make America Healthy Again, or MAHA, is contributing to the recent increase in scrutiny and litigation today?
Yeah, the MAHA cultural and political momentum is certainly fueling public discussion. And, we've also seen this political energy encouraging individual states to attempt to bypass federal standards entirely. We're seeing some states try to mandate highly visible warning labels on common ingredients or enact state-level retail bans on federally approved additives. And so here, the good news for the industry is that the industry has fought back on these successfully and has routinely secured preliminary injunctions by defending the First Amendment compelled speech doctrine. And so the real exposure here isn't necessarily losing the massive judgment, but it's also, the operational headache of trying to navigate this highly fractured state by state regulatory landscape where the states are constantly, challenging federal legislation and challenging where there's conflicts between the federal government, the regulations, and then also the states as well. So that becomes an operational headache for companies that we're seeing.
Mm-hmm. Christine, supplier concentration risk is not only a property and business interruption issue. If a disruption forces a rapid reformulation or change in sourcing, it can create a contamination or labeling risk. How should companies prepare and manage for that exposure?
Yeah, we see this. And, there's a very common domino effect here. Like a severe weather event could knock out a primary supplier of a core ingredient, forcing the supply chain team to scramble to keep the plants running. And they can quickly secure a secondary supplier. And on the production floor, the ingredient substitution looks completely seamless. But there are some hidden dangers that we see emerge because that secondary ingredient might carry a slightly different trace allergen profile, or the switch might force a minor formula adjustment. So if the corporate and regulatory teams are kept in the dark during that high pressure emergency sourcing decision, no one realizes that the thousands of packages sitting in the warehouse are suddenly non-compliant or mislabeled regarding allergens. And so the final blow lands when a climate-driven property or supply chain failure instantly compounds into multi-million-dollar consumer class actions and high-stakes class 1 recalls. So this is a reminder that companies cannot afford to manage these exposures in isolated silos because the operational reality of the business just doesn't live in a silo. It's always important to bring in regulatory teams, legal teams when making these types of decisions.
You are speaking my language here. That's exactly what we're trying to talk about, is just the interconnectedness of all of these risks, right? Like changing one supplier that looks identical might actually expose you to packaging issues. It could expose you to different business interruption exposures. And a lot of times these decisions are made quickly without the advice of legal counsel or without the taking a look at the actual operations and how that's going to affect ergonomics. I mean, there's so many things that kind of play into that. So you make a great point. And I think we should talk, Mike, I'd love to hear from you specifically around that climate-driven concentration risk that Christine just mentioned, right? You have a supplier that goes down. What are the geomapping and predictive analytics tools that are changing the way that underwriters and operators are looking at concentration risk across growing regions and supplier networks that our hub clients are using today?
Yeah, well, first of all, Christine, that is very interesting, that angle. I had never thought of it, me spending my whole career on the property side. But yeah, this is really the natural catastrophe modeling, the geomapping, they're becoming really table stakes, right? I was in the business when they were first introduced, believe it or not, in the 1980s. And I've seen a lot of successes from the catastrophe modeling and also some failures. But it doesn't, in a way, it kind of doesn't matter, because from reinsurance to the major insurance carriers, we're all employing catastrophe modeling. So I really think what we need to do with our clients is to inform them and educate them on the strengths and the limitations of the natural catastrophe modeling and the geomapping as predictive tools, but not final answers. It really is putting something in their toolbox to help them make decisions and to identify, identify really vulnerabilities in their own supply chain within their company, and obviously in the suppliers that they're getting their materials from, and also where they're selling into. So we start with analytics, but we should expand to active mitigation. So the analytics are really, as I said, really just a tool, and from there we need to apply our reasoning and thinking about what that means to our clients. And our clients should be thinking this way, and many of them are. For operators, it is in their interest to understand their risks as well as possible operationally, so that they can get the best story in front of the insurance marketplace. So it really is married together. And that analytics piece, it informs our clients for their own operation, at the same time provides better outcomes in the insurance market as well.
So when we think about how our carriers, our insurers are using this kind of data to re-underwrite certain corridors, what does it mean for an operator to be using the same data proactively rather than finding out about it at renewal?
I think that's the greatest service that we can do to our clients, is to put them in the driver's seat. And analytics is one of those pieces. We really shouldn't be waiting for the insurance market to tell us and our clients exactly what they're thinking about it. We should have the insight ahead of time. So really what we want to do is get those analytics tools in, right after, and not just at renewal time, but through the entire process. As you said at the very beginning, and circle back to that, this is a living process, an organic process. So what we want to do is we want to get ahead of the market through the analytics that will allow the clients in the food and beverage space to proactively apply their risk appetite and go to market with a targeted plan. So it's a combination of seeing what the risk is, looking at their own risk appetite is, and then developing a strategic plan around that, and actually dictating to the extent possible to the market what they're looking for. And that might sound maybe a little aggressive, but it works, especially in this market when we're seeing, some relaxation in terms, conditions, and pricing. So it's really taking initiative and developing pricing targets, and even program layering targets, if that's applicable, well ahead of renewal. And by using these analytics tools, it really puts them in the driver's seat, so that it's a conversation that they can lead and not just be a victim of.
And how often, Mike, are your best in class clients looking at these predictive analytics tools? Annually, biannually? What's the best practice in your opinion?
Yeah, definitely annually. And definitely well ahead of renewal time. So yeah, the best in class practice would be to be looking at these, to be really integrating it as part of an ERM, a complete, enterprise risk management program, beyond just managing of the risk, the 360-degree view of risk, not just the implications in the insurance market.
And beyond insurance, how should this data be used in informing decisions for food and beverage clients specifically?
Yeah, well, what is good for a resilient manufacturing platform is good for, and ultimately good for insurance outcomes as well. What I really mean is this process should be integrated as part of continually looking at the supply chain and delivery of that important product and brand to market, the brand awareness, the brand reputation, all of those things. In the resilience of that manufacturing platform, it really needs to be focused on the needs and the purposes of our food and beverage clients, especially in the food and beverage space, because it is a vulnerable food supply chain. And what is done then is to make it simply make that transparent to the insurance market. And I'll tell you, it will move the needle. It will make a significant difference when all of those steps are well recognized by our clients, addressed and mitigated to the extent possible, and where they're not possible, a clear conversation around those and to engage the insurance marketplace results in much better outcomes in the insurance process as well.
Yeah, I mean, I couldn't agree with you more, Mike. I feel like carriers are pushing for more information than ever with respect to sourcing and expansion in these facilities, right? They want to know before it becomes an issue, where are you getting your supplies from? And how are they, the insurance companies, how are they protecting their house in terms of how long it's going to take to get you back up and running? So I think being proactive as a client is not only going to help your business be better, but it's going to be reflective in your insurance premiums, in the way your programs are structured, and also it's going to drive better results for your partner in the insurance company, because they're not going to feel the loss as significantly if you had not used those analytics to inform your decision-making process. So this has been super helpful. I think, we've talked today from a core message perspective that our food and beverage clients are often running programs that might be antiquated, right? If you're looking at your insurance program on an individual line by line basis, so if you're looking at property separate from casualty, or from product recall separate from product liability, you are not getting really what your money is worth in terms of risk management. If you're not looking at this holistically from both insurable and uninsurable risk, you are not protecting your house adequately. So I think having conversations like this, and then also bringing in enterprise risk management from a heat mapping perspective, right? Talking to the operators in the facilities, talking to the legal teams who are responsible for contracts with suppliers and with customers, talking to the C-suite about different exposures that might be on the horizon, understanding the acquisition activity. There's so many moving parts to making sure you're adequately covered and understanding the risk profile of your actual organization. I think, having conversations like this can really move the needle in protecting the house. So before we wrap, I want to give Mike and Christine each a chance to leave you with one final takeaway. So Mike, why don't we start with you?
Okay, sure. 3 things come to mind really quickly. One is that, business interruption, including contingent BI, really relies on solid supply chain mapping. So what you really want to be looking for is financially grounded BI, transparency and recognition to get the best outcome in the marketplace, and also obviously operationally to put yourself in the best position as well. Also think of it as in terms of values. We're always kind of scared if we have the right values. Think of it as a dynamic process, dynamic asset valuation, always keeping in mind your insight into your own company provides you the best insight into the rest of your company. And finally, using sophisticated risk data to negotiate terms, to put yourself in the driver's seat, not just to satisfy submission requirements. We're not throwing a submission over the wall. We're engaging with human beings on the other side, on the carrier side, that we want to show the best possible profile of each client. So those would be my takeaways.
Thanks, Mike. Christine?
Yeah, so my final charge to everyone in the room today is to go back and audit internal communication timelines. Mike, you really nailed it. It's that human aspect. In today's aggressive regulatory and litigation environment, treating legal review as just a final rubber stamp right before a product launch or a reformulation is truly a recipe for disaster. You cannot afford to look at your casualty insurance, your distribution agreements, and your media or labeling liability as a separate item. You need to really look at them holistically, making sure that the entire legal risk framework is actually built for the realities of today's market, which includes heavy packaging compliance and relentless labeling scrutiny from the plaintiff's bar. And so to get ahead of this, you need to pull in your legal and compliance teams out of their silos and bring them directly into the product development and supply chain stress testing workflows as early as possible. At the end of the day, the absolute best way to win a consumer class action lawsuit or to stop a regulatory enforcement action is to ensure that it never has the legal footing to be filed against your business in the first place.
Yeah, it's the best claim is the claim that never happened. It's a similar mindset, I think, from an insurance perspective as well. So now I'm going to open this up to questions from our audience. Thank you all so much for joining us. We'd love to hear from you. We've got a couple of questions already coming through the chat. The first question is for Mike. Mike, what are food and beverage companies focusing on today that is moving the needle in terms of pricing in the property insurance market?
Well, that's a great question. It really comes down to the fundamentals. Sounds like a pre-season football conversation. The fundamentals. When we're looking at the food and beverage industry, there's some key pieces that are challenges, right? There's the dust hazards, there's ignitable liquids, and in some cases, there's certainly construction issues in terms of perhaps insulated metal panels. Also, obviously, the basics of fire protection. Believe it or not, it still comes down to those items. Natural catastrophe, we talked about a lot. That is a driver, and that's something that I think we covered very well. But I think in a lot of cases, what I'm seeing with the clients is we really need to focus like a laser on those pieces. For example, if you have a dust hazard, you really need to be going out and getting a dust hazard analysis. It's a painful discussion sometimes, I know, but number one, it really does make your facility a much safer place. You do not want to be on the front page of one of those incidents. I've been in a couple of those very serious incidents in the past. It's just not where you want to be, and it happens. But the second piece is it's a very sensitive point on the insurance side as well right now. So that would be an example, as well as flammable liquids and ignitable liquids. I think kind of focusing on those key hazards that are inherent to the food and beverage industry are really still the biggest pieces to be looking at.
Absolutely. And I think too, when we talk about dust hazard analysis, just as an example, I know it's not everyone's favorite topic, and I know it's inherent to the business, but you're not only protecting the building from exploding, you're protecting the people from breathing it in. Like there's so many, again, it's so multifaceted. All these things play into each other, right? So when you take care of one thing, you might be actually offsetting another exposure that you might not even be thinking about. So I think you're spot on. The next question is for Christine. Christine, what are the best-in-class food and beverage companies doing to protect themselves from class action lawsuits?
Yeah, that's a great question. And, given the sheer volume of filings we're seeing across the board, manufacturers and brands must really shift how their internal teams communicate by tearing down those silos that we talked about. between corporate legal departments and the quality or research and development teams. Historically, legal is typically looped in only after the fact, usually when a demand letter or a formal notice of violation lands on someone's desk. So to mitigate risk in this aggressive environment, legal counsel needs a permanent seat at the table from the very beginning of the product life cycle, participating directly during the initial formulation stages, packaging design phases, rather than acting as that final rubber stamp. And beyond early integration, it's so important for companies to focus on substantiating every piece of information displayed on their packaging. This means creating a fully documented audit trail for every marketing claim made, such as zero sugar or specific flavor profiles, as well as that back of pack compliance markers like recycling symbols. And because supply chains are inherently volatile and emergency ingredient substitutions do frequently occur, having that ironclad data-backed record for every shift is really the only way to ensure that a sudden sourcing adjustment doesn't accidentally transform a compliant product into that multi-million-dollar labeling lawsuit. And so it's really looping in regulatory and legal teams from the beginning, staying ahead of those trends that we're seeing. There's new litigation trends and theories coming down the pipeline all the time.
Yeah, so the message here is don't forget about your legal team when
yes,
early in the process.
Yes, exactly.
And while we're on that topic, don't forget about your insurance team either, because there's things that we can do to proactively help you manage risk before it becomes an issue. So that's a great reminder. Thank you, Christine. Okay, so we've got time for one more question. This one is for Mike. Mike, typically, what would insurance carriers be looking for to substantiate supply chain resilience in terms of capacity or alternative sourcing?
I'd like to once again steal a little from Christine here when she talked about tearing down the silos. We really have to have an organization that is communicating really well and integrated across all functionality in terms of business continuity. We really, to prove that the supply chain is resilient, we really need to see an active, living business continuity plan that is exercised and updated annually. It should be tested through tabletop exercises. Now, everything I just said will overwhelm some of our clients, right? Because I've worked with clients that are Fortune 100 clients, global entities, but also with 1 and 2 and 3 location clients as well in the middle market space. So really, this is a very scalable approach. It doesn't mean you need to have a 50-page document. It needs to be customized to your operation, but you need to be thinking about that and then exercising it. I can't tell you how many food facilities I've walked through and I've asked them about their suppliers, and they said, oh yeah, there's another company that can supply what we need. And unless they have a contract or they've tested this or they have redundant suppliers, really, the insurance market isn't going to truly respond to that. So when that client is going out to look for a high contingent business interruption limit, if they're opaque or they don't really have clear line of sight around that or contracts, really they're not going to open up a robust limit on contingent BI because the insurance carrier just sees kind of and something that they're looking to or hoping to get in the case of an extreme event, not something that they've tested and really implemented. So I would say that's the key.
So they're underwriting to assume a total loss as opposed to, even if you have like a sort of plan, it's not going to be underwritten to assume that you have a plan at all.
Yeah, especially on the contingent BI piece, right? Frequently that will have a much lower sublimit. The BI itself within the company is more identifiable because you can, fill out the business interruption worksheets. But when you start to pull in the contingent BI, you might only get 15, 20, $25 million limit when you think you might need a $100 million limit. Insurance carriers are just not going to put it out there unless you have this clear business continuity plan that's been exercised with redundant suppliers, contractual agreements, supply chain mapping. All of these things are difficult in larger companies, but certainly still need to be addressed.
Right. Well, thank you both so much for your expertise, your candor. This has been a great conversation. I've learned a ton. Thank you for participating and being a part of this. As a parting takeaway, I'd love to share this useful tool that Hub has created to take a critical look at your risk maturity as a company. I've personally taken this just to see how long and how arduous it is. It's really easy. It takes 3 minutes, but it will tell you, it'll tell you a little bit about your risk readiness across 4 different areas: governance and structure, culture and communication, technology and tools, and preparedness and response. If you take this, scan the QR code, it will bring you right to our risk assessment tool, and it will give you a rating of how ready you are for any risk that falls in those 4 categories, and we'll give you a score. And then from there, it's just knowing what you don't know, right? You're learning a little bit more about your organization. Where can you leverage your strengths, and where can we improve upon the weaknesses that you may have in your risk maturity assessment? So please take that and use it as a tool for grading your organization. And please, follow us for more content around food and beverage. We're putting out new things every single week. And thank you so much for being here and joining us here at Hub. We're excited to learn and hear from you and how this was helpful. Would love ideas for content moving forward. Thank you for participating, and I hope everyone has a great day.
Thank you.
Thank you.